We finished up talking about lines 24A and B on Schedule C, which was travel and deductible meals. And we're moving on now. Line 25 is utilities. And we'll note that the utilities are, let's see, I'm highlighting in green the ones that are fairly common. Utilities are actually not that common because utilities only counts utilities you pay for your business location, like the office you rent or warehouse that you know, your business location. If you pay utilities as part of your business use of home, that does not go here. That will go instead on the business use of home worksheet, which will come up a little bit later.
If I had a separated garage from my house with its own power meter that was strictly for my business.
No, it's still going to go on business use of home because it's on the same lot, so it's still considered part of your home.
Really? Even with a
It's
separate
attached
power
building.
meter to a separate building?
Yeah, even if it's a separate building and all that, it would still go on the business use of home because that's part of your home. If it was on a separate property, then it would be counted separately. Okay, and then wages are pretty rare. Most of our clients don't have employees of their own, and so you would have, this is wages that you pay to your employees. We never count the business owner as an employee for sole proprietorship. And finally, we have 27, which is other expenses. Anything that doesn't fit into one of these previous categories, we can list here on Part 4. We'll see things like dues and subscriptions, the continuing education, and things like that. And that finishes up most of Part 3. So we have all of our income from Part 1, and then all of our expenses from this section of Part 3, at least lines 1 through 27. 28 is where you total up all of your expenses between lines 8 and 27, and then you subtract your expenses from your income. And you'll get something that we'll call your tentative profit on line 29. And this is basically your profit before counting any business use of home deduction. And the reason is business use of home deduction is only deductible if you have a profit. If you already have a loss at this point, then there's not going to be any business use of home deduction, except in some exceptional cases. So basically, the business use of home deduction can only reduce your profit, but not generate a loss. It will carry over from one year to the next, so if you have a loss for several years and then finally you have a profit, you can use that carried over business use of home deduction in that profitable year. We'll get to business use of home and how that is calculated. There's a full calculation, and then there's also a simplified method, which is basically $5 per square foot for the whole year. So if you have a one bedroom, maybe it's 12 by 12, that's 144 square feet. $5 a square feet would give you a $720 deduction for the whole year. So that's not very generous at all, but it does get you around having to worry about keeping track of a lot of things.
Doesn't that one max out at like 1,500 or something like that?
Yeah, it maxes out at 300 square feet for a total of $1,500 deduction.
So if you got like your shop space or your garage space that's clearly more than that, then it would stay.
And in general, it costs a lot more than $5 a square foot to maintain a home, especially in Alaska. But I think throughout the whole country, it's a lot more than that.
Would you expect that in the next year or two they may actually up that one? No?
No, that is not adjusted for inflation in the tax code, so it would be up to Congress to change that.
Gotcha.
Okay, and then after we've taken your business use of home deduction, then we finally have your net profit or loss. And then your net profit or loss, if you have a loss, you also have to answer these two questions, 32A and 32B. That's usually going to just be blank on both, or it's probably usually going to be 32A is checked. That's just asking whether all of your investment is at risk or not, meaning do you have some sort of limited liability agreement so that if you lose money, you're not actually going to lose all of your money. Maybe you have a non-recourse loan, like a business loan that says if you lose money, then you don't have to repay the loan or something like that. So it's very rare for less than all of your investment to be at risk, at least for our clients.
What's the 50% and 80% DOT?
That's for standard. That's for meals. Meals while traveling.
That's right.
Meals are only 50% deductible if you're, except if you're subject to DOT hours of service restrictions, you can deduct 80% of your meals instead. Okay. Then we'll talk briefly about parts 3 and part 4. Part 3 is cost of goods sold, and the way this is calculated is if you are reselling goods, you buy some and you sell them, and you can only deduct, it's not technically a deduction, but you only get to deduct the value of what you sold during the year. So if, let's say I'm running a thrift store and I go to a bunch of garage sales and I buy stuff and I resell it in my store, and I spend $8,000 and I only sell half of what I bought during the year, then I only get $4,000 cost of goods sold deduction. And the way that works is we have your starting inventory of the year, and then we add on your purchases. So this is starting inventory plus your purchases. And then there's other costs that sometimes go into your inventory, but we'll skip over those. It's a little bit rare to see any of those. So your starting inventory plus your purchases is known as your cost of goods available. This is what you had during the entire year that you could have sold. And then we subtract off of that. This is everything that you could have sold minus what you haven't sold yet. So you don't get a deduction for what you hadn't sold yet. And this gives you your cost of goods sold. And this number ends up over here on line 4 of page 1. And you only really have to worry about this if you're buying things for resale. And then finally, part 4 is information on your vehicle. So if you're taking the standard deduction and you only have one vehicle, you don't have to fill out a vehicle worksheet separately. If you do have more than one vehicle, then you would, or you're taking actual expenses, you would have to fill out a form 4562. But if you're just taking the standard mileage deduction, you can just put the information on your single vehicle directly on the Schedule C here. When did you place your vehicle in service?
What was form 4562 again?
4562, that's the form for depreciation, and that's, hopefully we'll get to that later today. So it's going to ask, when did you place your vehicle in service? How many miles did you drive for each of these purposes? Business, commuting, and other personal. And then 4 questions. Was your vehicle available for personal use during off-duty hours? Yes or no? If you're claiming 100% business use, then you should probably also have that not available for personal use. That means you're leaving it at your business location and using your personal vehicle to commute back and forth to home.
So given that you were saying that they take the percentage of business use versus personal use, the mileage that you should report should effectively at that point be your total mileage. Don't separate it. and
No, it
then
needs to be
percentage.
separated. Business use, commuting, and other personal use.
Okay, but so then after you put in just your business miles,
Mm-hmm.
then is that business miles value going to then be like 75% of that? Which
No.
would-
No, it's gonna be, so let's say your business miles are 8,000. And your commuting miles are 1,500, and you have another 1,000 in other personal use. So that's total, your business use percentage is gonna be this 8,500 divided by 12,500.
How'd you get 8,500 from 8, 15, and 1?
Or, sorry, 8,000.
Okay.
8,000 divided by that, which is gonna be something like 64%.
And why is it 12,500?
8, 9, 10,500.
So is that percentage basically most relevant when you're not doing the per mile, but you're doing the actual costs?
Yes. Yeah, that percentage is only relevant if you're taking actual costs. So this is gonna be something like 78%. So that means out of everything that you put into the vehicle, insurance, fuel, repairs and maintenance, depreciation, all that stuff, 78% of that is gonna be deductible as auto expenses. But if you're taking actual expenses, you wouldn't use this section. You would just use the standard mileage deduction, which in 2023 is 65.5 cents per mile. 2022 there was a split rate. It was 58.5 cents a mile for part of the year and 62.5 cents a mile for July through December. Okay, and then if you're claiming 100% business uses, you probably shouldn't have that vehicle available for use during off-duty hours. But most people are going to mark yes here, and that means you're probably using it at least partially for personal use. Let's see, do you have another vehicle available for personal use? Again, you really can't claim 100% business use if you don't have another vehicle that you're using for your personal business. So some people might have no, some people might have yes there. 46 and 47, sorry, that was 46. 47 and 40A and B should always be yes. Do you have evidence to support your deduction? Basically, if you say no, you're begging the IRS to delete your vehicle use deduction.
What was that one? Do you have evidence?
Do you have evidence to support your deduction? And is that evidence written? And that has to be yes also. If it's not, then basically the IRS is going to delete your car and truck expenses.
So why do they have commuting and then other? Why do they have two other categories besides business? If everything besides business is irrelevant anyway.
Because they want to help remind you that commuting is not deductible. So going from home to work and work to home is not deductible. And then like going grocery shopping is obviously not deductible. So that basically helps remind you that you should have, unless your home is also a business location, you must have commuting miles. Okay, so we're going to skip a lot of the slides, but we are going to stop with some highlights. So, for any business expenses to be deductible, they have to be considered ordinary and necessary. And those both have actual specific definitions instead of just their ordinary English definitions. Ordinary expenses are expenses that are common and accepted in your type of business. And necessary expenses are expenses that are appropriate and helpful to your line of business. So basically, you can only take deductions for expenses that in some way help you make more money. Or maybe that they're required because, you know, of government regulations or something like that.
So if someone's, you know, running a business and not doing anything weird, more than likely, pretty much all their expenses are going to be ordinary necessary.
Mm-hmm.
What would you say are like the most common ones you see that are not either?
So what I would say, so the example I often give when we're talking about ordinary and necessary expenses is if you're an accountant and you buy a helicopter, that is not the normal type of expense that an accountant would purchase. So that is probably not deductible as an expense. If you were a fishing and hunting guide though, and you bought a helicopter, that probably is ordinary and necessary to your business. So really it's, you know, do other people in the same line of business incur the same type of expenses?
Okay.
Does it actually help you make money somehow?
But then again, if that accountant opened up a side business of like, you know, a remote winery or, you know, something backcountry, and they could easily justify it on a separate business that was more in line with that type of expense, right?
Yeah, and that would be a different Schedule C. And so it would be ordinary necessary to that business and not to their accounting business.
Can I ask you an off-topic question? Somewhat off-topic.
Yeah, go ahead.
In terms of people wanting to expense a fishing boat, what have you seen that is the most common way that you can actually do that legitimately? If you aren't specifically like a fishing service.
That's really the only time I've seen anyone try to deduct expenses for a fishing boat. We have a couple clients that do fishing charters, and we have a couple of clients who are commercial fishermen, and that's where we would deduct the fishing vessels.
So you might be able to do it as like the second home thing, on like mortgage interest on a second home that has a bathroom that's big enough.
Mm-hmm.
But if someone uses the boat, you know, throughout the short part of the season for transportation on like a construction project, would that potentially be justifiable enough?
It depends. It depends on how much money you expect to make out of that project. So is it really necessary for your business, or would it be more profitable to rent that transportation? Or maybe you buy it short term and resell it, you know. But if you're, we do have another client who does bush deliveries. He basically buys groceries and delivers them out to the bush and resells them. Mm-hmm. And so his water vessel, it's not a fishing boat, but his water vessel is an ordinary expense for him because he's making deliveries out to rural Alaska.
So if I got a contract with MEA to do power lines and stuff along with the rivers and lakes, I could use my boat as a...
Mm-hmm. Yeah.
Have you seen that in scenarios like that, if someone already has an item that they then want to use as part of the business, if there's a way for them to expense the item that they already own, say call it like a $5,000 boat?
They would have to take depreciation on that.
So they can put it into the business, but they can only depreciate it?
Yes. Mm-hmm.
Okay. So they just can't get an immediate expense, they just have to drag it out?
Mm-hmm.
Okay.
Okay, now we'll talk about business use of your home. So if you use part of your home for business, even if the business is not your full-time job, you can deduct certain expenses for the business use of your home. So you have two choices. You can either deduct a standard amount, $5 a square foot, or you can deduct a portion of your actual expenses, a percentage. And that $5 a square foot is so low. I had one client who misunderstood the rules, and when she sent me her profit and loss for the year, she's actually deducting $5 a square foot per month, which actually looked very reasonable to me. So I didn't really catch it until later on when I actually went through line by line her entries. So that was a little bit embarrassing, but yeah, $5 a square foot is much lower than what your actual expenses will turn out to be. Okay, to deduct any business use of home, you have to meet 2 tests, and that is first, you have a principal place of business test, and second, you have a regular and exclusive use test. Okay, so principal place of business test means it's a principal place of business, not necessarily the principal place of business. So this test is met if you use a portion of your home as a principal place of business, like you're doing most of your manufacturing work there, or if you're using that portion of your home to meet with patients, clients, or customers on a regular basis. Or it doesn't have to be very principal. If it's in connection with your business and is a separate structure not attached to your home, it also passes the principal place of business test. So like a detached garage, it's still going to be part of your home. It's a separate structure. Or if you build like a workshop that's not part of your home, that's not connected to your home but is on the same lot, that would be part of your home for purposes of whether you're going to claim it on your Schedule C or the business use of home worksheet. But it will pass the principal place of business test if it's a separate structure.
You're saying it's a separate structure, it's a lower bar effectively to
Yeah,
make
it's a lot easier to count it as a business use of home if you have a separate structure.
But if it is a separate structure, and it's say you got like a 3,000 square foot garage and a 3,000 square foot home, where it's like equal square footage in a way, but I guess what I was just thinking about is if someone owned their home outright, would they effectively only be able to do utilities and property taxes at that point? Or is it
And depreciation, yeah.
and depreciation?
Okay, so here's some examples. If you work out of your home as a freelance writer, a mail order seller, like in other words a drop shipper, maybe you work remotely on a contract basis, maybe you do people's taxes out of your home, and that kind of thing. Those would all be things that would help you meet that test. There's quite a few, I don't know how common it is, but I've seen several attorneys who live in who have their offices the downstairs and they live upstairs or in the back or something like that. So that would be, they're meeting clients there and they're doing all their work from home. So that would be also a principal place of business. Yeah, in this example, this guy is making greeting cards at home. So that would be a principal place of business. Like wherever you make most of your money would be a principal place of business. But here it says, if you regularly meet patients or clients at your home, that could also be a principal place of business, even if you make most of your money outside the home.
So even if it's just a side hustle, it's not your full-time job,
Right.
you still can
Right, because it's only related to that business. So this guy in the example, he works he's a school teacher by day, but a greeting card artist by night. So we're only worried about principal place of business for his greeting card business, not his school teaching job.
If someone operates 2 businesses out of their home, are they still limited by the 300 square foot, 1,500 max?
The 300 square foot limitation only relates to the $5 square foot.
Right, but
And it would be 500. It would be 300 square foot total.
right. So in a scenario like that, if they use their office for one business and they use the greater portion of their garage for another, for example, they have 2 businesses, would they be able to take that per square foot twice, once for each business, or would it be cumulative somehow?
I do not know, but I'm pretty sure I'd say about 60 to 70% that you would have to take actual expenses for both businesses or this simplified method for both businesses, and you'd be limited to 300 square feet overall.
Okay.
Okay, so if you operate at more than one location, and you're not one of those exceptions where you regularly meet clients at home or it's a separate structure, you would have to determine whether your home office is a principal place of business, which is whether it's the main location of the business activity. So let's say you were a house painter, you make money, most of your money, at your clients' homes, your customers' homes. So even though you're making most of your money outside the home, the only place you have to store your paints and your ladder and your drop cloths and all of your other equipment and supplies is at home. So that would make your home your principal place of business. So so this is generally true, but it's not 100% true, where it's the place where you actually earn your money.
When you were saying that you'd have to do a depreciation, if someone goes to sell that property,
We'll talk about depreciation and selling property in the next 2 chapters.
Okay.
If you perform essential aspects of your business at home, like bookkeeping, invoicing, other administrative activities, that alone does not make your home the principal place of business. So it does, however, because the place you actually work at is unsuitable for taking care of those administrative activities, then taking care of them at home makes your home a principal place of business.
So in the case of construction projects and stuff where you're not doing administrative duties on a dirty, dusty work site.
Right, yeah, you're not going to sit at the work site and pull out your laptop in the middle of all the dust and noise and try to run your QuickBooks.
What if in the scenario where someone has a construction company, they have an office, but then they also work out of their home office?
Then that's not going to count.
They won't basically be able to count their home office at all at that point?
Right.
Okay.
Right. So, for example, if this were my office and I also worked from home, I would not have a principal place of business at home. I would not be able to take a home office deduction because we have computers and we have quiet time. We have separate offices. We could easily take care of all the administrative activities here. So, by doing that from home, that's not a business necessity. That is more of just my own convenience.
But if someone doesn't have an actual office space or actual business location, then it's pretty easy to meet that bar of business use because you don't have any other place for it, though, right?
Mm-hmm. Yeah. So one example would be someone who rents a kitchen and makes makes meals to go, or makes candy or things like that. Things that they're going to sell maybe online or at bazaars around town. And well, the kitchen itself is not suitable for their administrative activities, so they're not going to do their billing and invoicing and bookkeeping in the kitchen. They're just going to take that home and take care of it at home. So that would be another example of where your business location is unsuitable for administrative activities, so you have to do it at home. So to fit under this exception for the principal place of business test, you have to have a basically ironclad business reason for doing these administrative activities at home.
If someone doesn't work from an actual office, but they're between the kitchen and living room and kind of just all over working there, is it complex for them to figure out how to take the deduction?
No, it's very simple. You don't get the deduction.
Oh.
Okay. We'll get to that second test. That'll be regular and exclusive use. Business use of home is often referred to as the home office deduction, but it doesn't really have to be an office. It can be storage, or it doesn't have to be an office. It could be a workspace, and things like that. Okay, Grand has a greenhouse, and that would be a separate, a separated building, and that would count as a principal business location for his home office deduction. It's not a home office deduction, it's business use of home is the technical term. Okay, then here's another exception to the principal place of business test. You can take this deduction even without meeting the principal place of business test if your home is the only fixed location of your business. So if you are like a house painter, or one of the examples was someone who paints murals, and you have no address basically for your business other than your home, then your home will be considered a principal place of business for this test. And if you are storing inventory and products in your home, it doesn't have to be a principal place of business anymore, as long as you're using up part of your home for storage. So that was all the first test. The second test, remember, they both have to be met. So the first one was principal place of business. The second one is regular and exclusive use. So the IRS can be pretty strict about this exclusive use test. And what this says is, well, basically what it, I guess they don't really go into much more detail except for that. What this basically says is that area of your home has to be exclusively set aside for business purposes. So if you are, we had this example of this guy who's making greeting cards. If he's just doing that on his dining room table, but the rest of the time when he's not in business, he's just using it as a normal dining room, then that's not exclusive use, and that will not qualify for the business use of home deduction. So, and the IRS can be pretty strict about this. There have been court cases, for example, where someone had, a separate bedroom that they used as a home office, but turns out, after the IRS audited him, they found out that that he had actually let his brother stay there for 2 months of the year. Well, it's no longer exclusive. The deduction is gone. Another example was someone who tried to claim their dining room area as exclusive use of home, but it turns out that during the holidays when they had family over, they would clear that stuff out and use that dining room table as where they host dinner. And that destroyed the exclusive use test and got rid of that deduction.
That one meal, effectively?
Yeah. You used it 2 days, use it Christmas and Thanksgiving. For non-business purposes, that means it's not exclusive, that means you don't get the deduction. Okay, so here's an example. Lisa watches TV part of the time and also sometimes manages her business from the same room. That means it's not exclusive use, she won't get the deduction. Business use of home. The exclusive use test does not necessarily have to be an entire room, but it does have to be an identifiable area where you can point to, this is where my office or my business use of home begins, and this is where it ends, and that's my business use of home. So for example, when I was a cab driver in Fairbanks, I had a filing cabinet where I would store my trip logs and keep stuff that I needed for that business, and it took up 4 square feet, and that's my business use of home. I was not making a lot of money, so I needed every deduction I could get, but that, I had a tiny apartment too, so that actually came out to be fairly decent percentage, but that's business use of homes, that counts. If you have a desk in one corner of your living room and you're using that exclusively for business, so you're not gaming on it or watching videos or anything, but you only have it there, that desk with the computer on it, and you're using it 100% for business, that could be, you know, your 18 square feet or 15 square feet or however long your desk area is, that's business use of home. We've also taken this deduction for people who are in some of these home selling businesses like Pampered Chef or things like that, doTERRA, and they have half of their closet for storage, half of their closet is their business use of home. So you can, so as long as you have some identifiable part of a room that you can count as your office.
So with the square footage thing, I have one room in my house that's gonna be dedicated nothing to the business. But I don't think it's, it might be 300 square feet. But in my yard, I store all kinds of equipment, I'm storing wood and stuff like that. So would I be able to use up to 300 feet of yard space, or is that just indoors?
That's just indoors.
Okay.
So we might have to come up with some other way to allocate besides just square footage. But the normal way to do that is by square footage.
So would that be almost like you do a percentage of the home plus the percentage of the yard and get like a weighted average of some sort?
Yeah, something like that. Okay, if you have more than one business operating in your home, I think this is worded incorrectly. What it's supposed to say is that area of your home must be exclusively used for business, but it can be used for like the two businesses or multiple businesses. And you would have to allocate this deduction between the multiple businesses.
So if you have like a 1,000 square foot garage, and each business currently has more than 300 square foot potentially, but even if one's 40/60 or it's 50/50 and they're both maxed out, then they're sharing this large space, it wouldn't matter.
Right. So you might use your garage, your 1,000 square foot garage, both to store your painting materials and supplies, but you also build furniture. Those would be separate lines of business and go on separate Schedule Cs. But it's just all mixed together in the garage. So you have your tools, your woodworking tools, and your painting tools and supplies, all stored in the garage. That is could be regular and it could be exclusive use, but it's not exclusive to one business, but it is exclusive to business in general.
So then it's just up to you to figure out the percentage or how to split it.
I have a couple of clients who have fingers in all kinds of, they have like 5 or 6 different Schedule Cs. They have a lot of different businesses going on, and they have one room that's dedicated to running all of their businesses, all their QuickBooks, their business activities, mailing, everything is all one home office. And that home office deduction, it is exclusive not to any particular business, but it is exclusive to all of their businesses. So that deduction has to be somehow split up between the businesses.
So in a case like that, if it's larger than the 300 that you max out with the simplified method, then
I never use the simplified method.
No.
The simplified method is garbage.
Not even if you have multiple businesses to.
The simplified method is garbage.
No.
It's $5 a square feet for the entire year. And that's, if you're renting a 1,000 square foot home, that's basically almost $2,000 by itself for rent. So you're already up to $24 a square foot just in rent. So the $5, yeah. The only time I would take the simplified method is if I wanted to increase someone's income in order to get the earned income credit. Because otherwise, it's just, the simplified method is just trash. So don't even think about the simplified method. Don't worry about the 300 square foot. I mean, the only time I would take it is, if I wanted to make sure my client had positive income so that they could get the earned income credit or additional child tax credit. Okay, yeah, this example, the previous slide was basically written wrong. This example looks correct to me. Nick has 2 separate businesses. He's a freelance writer and runs a lawn mowing business. He has an office in his home for his freelance writing, and he uses the same room to keep track of his receipts and his bookkeeping for his lawn mowing business. Both businesses pass the exclusive use test, or kind of like that room passes the exclusive use test, considering all of his businesses together. So then he can take the deduction. But if you use that room for some third personal purpose, then that would erase the whole deduction.
If someone has a home office and they keep a futon in there, and the occasional guest like sleeps in there,
Then it's not exclusive anymore, and it's done.
even if during the day it's used up, but they just crash there in the night or whatever.
It's not exclusive. If you have guests there, if you have any other purpose for that room besides just maintaining your business, then it's not exclusive and you don't get the deduction.
Okay.
All right, so we have a couple of exceptions to the exclusive use test. The first one being daycare. A lot of people run daycares out of their homes, and you let the kids, use almost the whole home. Maybe the only place that's off limits is maybe your bedroom and maybe your office space. But once the kids leave, the IRS is not going to require you to section off and say, oh, I'm not allowed in the living room anymore because I want to keep the exclusive use test. So daycare does not have to use the exclusive use. It does not have to meet the exclusive use test.
So how do they count the percentage then?
They count the percentage. Well, first of all, they're going to count the percentage by the percentage of square feet to the whole home. But then they're going to have a second percentage to multiply by, which is the number of hours you use that area as a daycare out of the total number of hours during the year.
So it'd be 8 out of 24 hours, as opposed to you count the sleeping hours and stuff like that too.
It's pre-printed on the form. It's 8,760 hours per year. So if you operate that daycare 8 hours a day, 5 days a week, and you go 40 times 52, that's going to be 2,080 hours. So you're going to take this percentage, 2,080 divided by 8,760, and that's going to give you about a quarter. And so that's going to say, well, that part that's not exclusive, you get to a quarter of the deduction you otherwise would.
Why is it 8,000? 8 times 40 times 52 is like 16,500. Roughly.
$24 hours a day, 365 days a year, 2,760. What did you say, 24 times 7 times 52? 8,736.
No, I did 8 hours a day times 40. I guess I counted hours incorrectly. It would have just been 40 times 52.
Yeah, so I was using my home, most of my home, 8 hours a day, 5 days a week, for 52 weeks a year, 2,080 divided by 8,760. So I would get 23.7% deduction.
Oh, so you take the hours used divided by the total hours of the year.
Right.
Okay.
Right, so sometimes we might have someone who is using their home for daycare, before and after school during the school year, and then 10 hours a day during the summer. And so we could add that up week by week and figure out how many hours. But it's the total number of hours during the entire year.
Gotcha. And all the evening and nighttime hours are all personal, it seems.
Yeah.
So,
And then, I don't know about this actually being an exception, but they're talking about, again, storage of inventory of product samples. So if you're using part of your home for storage, then you can count that as exclusive use.
That doesn't seem much different than the original.
Yeah, it doesn't seem any different. That doesn't seem like anything new. Okay, so assuming you've qualified for the business use of home, which means you meet the regular and exclusive use test and the primary place of business test, then one thing that's not really mentioned on the slides is that converts your home into a business location. And so driving from home to a business location is no longer commuting, that's going from one business location to another. So that's going to save you some money by allowing more of your vehicle expenses. So basically your daily commute is going from your bedroom to your office, which is, you can just walk that far in a minute or two. And then after you've made it to your office, then you go out and get in your car and drive wherever you need to go. And then you also get to deduct part of your home expenses based on a percentage of how much your home is being used. Okay, so your percentage is going to be divide the area of the part used for business, which is the home office plus storage or anything like that. But your business use of home, the part of your home that's being used for business divided by the total area of your home. In general, I would not count your garage as part of your living space unless you were including it as your business use of home. So if you had like an 800 square foot garage and the rest of your home was 1,500 square feet, but your only business use of home is one of your bedrooms, I would use the 1,500 square feet. So maybe your bedroom, one of your bedrooms is 150 square feet, and we divide that by, into 1,500, or divide it by 1,500, but we'd have a 10% deduction. But if you're using the garage, then I would include that in both the numerator and the denominator. So if I had an 800 square foot garage that I was using for business, and the rest of my home was 1,500, I would add that 1,500 in, and that would be something like 35%. In the case of where you're using part of your land without actually having a building or structure on it, have to get a little bit more creative. And the IRS does say that you can use any reasonable reconstructible method. So that means you have to be able to explain how you came up with it, and it basically has to pass the reasonableness test in order to allocate that. So I would probably look at your property, look at your home on my property, see what the value of the land was versus the value of the home. So maybe you live on 1 acre and your land is worth $35,000, and the home that you live in is worth, the building is worth $140,000, and so that's if I did that right, that should be like a 4-to-1 ratio. So I would say, if you're using this much of your land, you're using this much, like using 1,000 square foot of your yard is equivalent to using 250 square foot of your home, because the enclosed area is worth 4 times as much as the unenclosed area.
What if it's the other way around? Because like I live in 2 double-wide trailers, they only value that at like $12,000 on my taxes, but my property is almost 5 acres and they value that at $60,000.
Yeah, I would do something clever with your land value.
Okay.
What if, like, in a scenario where, a lot of land might not be developed at all, but you might, in some cases, you might have a lot of, like, gravel prepped, like specific, what's it called, lay down yard space, like specifically built up and prepped for like storage. The tax assessor doesn't count that in, cause like when they take like value of land, they're just looking at like raw land, not like partially developed for a purpose. Is that a subjective area where one can attribute a bit more to that land space if it has been developed some?
I would try to avoid using the term subjective, but basically yes. I'd have to try to come up with some defensible, reasonable method where I could explain to the IRS how I came up with this, and so it wasn't making up numbers, but.
But if it costs, say, $20,000 for the excavation of this storage space, that, or would one just basically want to depreciate that in some way?
Well, you could depreciate it, but as far as, and yeah, you could depreciate that, and then like the land itself, your improvements to the land would be normally depreciated, and then the land itself would be the same per square foot, or per square yard, per acre, whatever.
Okay.
Okay. Yeah, so here's an example. Georgie has a home office that's 10 by 15 feet, so that's 150 feet, 150 square feet. The total area of her home is 1,500 square feet. So doing that division, 150 divided by 1,500 gives her a 10% percentage for her home office. If we were just talking about land, like you were doing all of your storage outside, I might do square yards divided by your total square yardage of your land, especially if the buildings were like trailers that were low in value compared to the land.
Things like your driveway, would you like attribute half of it towards the business and half of it towards the personal, something like that?
No, because once you figured out your business use of home percentage, all of your expenses are multiplied by that percentage. So, yeah, this is where we get to any reasonable method can be used to determine the percentage of the home office, which means that if you haven't gotten around to measuring your home office and you don't know the total square footage of your home, you could maybe chunk your home up into areas of about the same size. So you might say, well, I have 3 smaller bedrooms and a master bedroom, which is about twice as big as the smaller bedrooms. Plus I have living room, kitchen, and 2 bathrooms that total up to the same size as one of the smaller bedrooms. So then we could say, okay, well that's about equivalent to 8 rooms total, and so now you're using 1/8 of your home for business use of home. That's a little bit less precise. I'd rather use square footage, but if someone really doesn't know, then we could like chunk up their house, maybe draw a sketch of what their home looks like.
So
And try
generally
to figure
speaking,
that out.
things like your hallway and bathroom and closets and stuff like that are default all personal, right?
Mm-hmm. Well, anything that's not business use of home, not that exclusive use.
Okay. Even if the hallway is the only way you're getting to the office, right?
Right, because unless you are using that 100% for business, maybe that's the only place it leads is to that office. Maybe you could count that.
Gotcha.
Like a lawyer's home / office, usually they might have a back entrance, like where they come in when they're coming in and out when they're going grocery shopping, and maybe the whole front half is just like their office. So like hallways and bathrooms and stuff in that area could all be exclusive use for business because they let clients use it and they don't use it during their day-to-day life outside of work.
Gotcha.
Okay, so, I mean, this makes more sense when you have smaller apartments. So you could say I run my business out of one room, out of my 5-room apartment. 5-room apartment would be more like a 2-bedroom apartment, because you'd have bedroom, and then your living room, kitchen and dining room, and bathroom. Bathroom's smaller, but the kitchen's larger, so maybe it averages out.
So they're not actually counting bedrooms in this case, they're counting
Rooms.
rooms slash chunks in a way.
Mhm.
Okay.
Yeah, maybe your floor plan looks something like this. So you just have a box for your home, and you have 2 bedrooms back here, and then maybe a living room area. Then you have a little bathroom here, and then you don't even have a kitchen. It's just all something like that. And we would say, well, that looks like about a 5th of the home. Looks closer to about a 1/6, but that kind of thing. You could do that.
Gotcha. So there's a little wiggle room on the precision end, but it has to be reasonable.
Yeah.
Okay.
Yeah, you have to basically, reasonable methods mean, anytime the IRS says any reasonable method, it means you have to be able to explain it to someone and convince them that it's appropriate. Okay, so if you're a daycare provider, you also figure out the percentage of the time your business operates during the year. So a typical daycare provider might be basically the opposite. They have the entire house except for their bedroom is their daycare. So they might have 80% of their home is business use. So we might have this percentage. 80% is their daycare, because the only place that's off limits is their personal bedroom. But then we also have to multiply by the percentage of time the business is operating during the year, which we figured a reasonable one was 20, rounded up to 24%. Although we should keep at least 3 significant figures when we're doing taxes. So
You're saying like point decimals, or
yeah,
what are you saying?
I would go like when I'm doing someone's taxes. Actually, I'm going to do 4 significant figures. I'm going to do 0.2374 instead of rounding it off to 24%.
Okay.
I'm not really sure what the requirement is for how many decimal places to keep on that, but see, 80% of 24% is 19.2%. So maybe round that to 19%, just for demonstration purposes.
Definitely, you would think from first glance that you would be getting a larger percentage if you're basically using your entire home for the majority of the day.
Well, it's only a third of the day. It's only 8 hours, and it's not every day of the week.
That would change though, if you were like a 12-hour daycare and you worked on the weekends too.
Yeah, it could be a lot higher, but it's almost, it could be like up to 30, maybe 40%, but I think anything more than 40% is probably going to be excessive for daycare. And in fact, if you're a daycare, you can actually mix these 2 strategies. You can have part of your home that is actually exclusively used for business, maybe like a diaper changing room, or something like that, or maybe a nursery that you don't use except for your business, and that would be 100% for business use. And then the part that's mixed, the part that would be mixed use, you'd have to multiply by this hours of use percentage.
So you kind of just take those square footage values out of the denominator as you calculate the rest of it.
Yeah. case, if you're gonna take that strategy, you would have to add a separate worksheet to the 8829, because the 8829 isn't built to handle that situation.
Is that just a piece of scratch paper that you kind of just draw it out or
Yeah.
show your math?
Yeah. Anytime that your calculations don't perfectly fit into something that, like the tax form that's pre-printed, you can always write C statement in there, and you would attach a statement to your tax return.
So do you guys have like a template you use for like business use of home deductions where you're able to write notes and show drawings essentially for simplicity?
Yeah, it wouldn't end up being attached to the tax return, but our software would let you do this, and it would produce a worksheet like this is the exclusive part and this is the non-exclusive part that's being multiplied by the daycare percentage. Okay, so this is an example of Christina, who only runs her daycare business. Looks like before and after school. So for 4 hours a day, 5 days a week. So she ends up with 9.5%, where we came up with 9% or 19%, which is double that for double the time. So that makes sense. And this is what the 8829 looks like. This is on page 400. And the top section is where you compute the percentage. This lines 4, 5, and 6 you only use for daycares. And then this part 2 is where you figure out how much of your deduction is allowed. Part 3 is for depreciation of your home. And part 4 is for carryover of expenses from one year to the next. Remember, your business use of home deduction cannot reduce your profit, can only reduce your profit to 0. It cannot create a loss or increase a loss. Okay, and then you'll notice that there's 2 columns here. There's a column that says direct expenses, and there's a column that says indirect expenses. Direct expenses means those expenses that are specifically allocable to just the home office. So if you are making repairs in the home office area, or you have a separate meter for your garage, electric meter, those would be examples of direct expenses, and those would be 100% deductible under direct expenses. Any indirect expenses are your expenses that pertain to the entire home, that only indirectly benefit your home office. So that'd be your mortgage interest, property taxes, general lawn care, maintaining your driveway, that kind of thing.
When we were talking about personal property taxes before, that would, for a lot of people, that may not be enough to get past need, or basically being beneficial to itemize.
Mm-hmm.
And you only get that you can only really use that if you itemize, right?
Well, on this, it becomes a business expense. So that portion of your property taxes and mortgage interest is deductible as a home office deduction.
Right. But I'm saying if someone only had like a $5,000 property tax bill, and they didn't have like massive medical expenses and such,
Mm-hmm.
they may not even be really deducting their personal property taxes in general, right?
Right. So you would normally not deduct your property taxes, but if you have a 20% home office deduction, then you can deduct $1,000 as a business expense on your business use of home worksheet.
Okay.
Let's actually back up here. So, indirect expenses, the most common ones that we'll see are rent and utilities, mortgage interest and property taxes, and homeowners or renters insurance. So if someone is renting, a lot of renters don't keep renters insurance, but if someone is renting, we'll normally would expect to see rent and utilities.
as their home office deduction. And that would normally be indirect expenses. For someone who owns their home, we would normally expect to see mortgage interest, property taxes, insurance, and utilities, and sometimes repairs. But those four should be on almost everybody's business use of home worksheet.
You say mortgage interest, so you can't count any of the principal
No,
in that calculation?
no, because principal is not an expense. You're paying down a loan that you took out.
Okay, even if you're using part of it for business, you can't use part of that principal that
No.
you pay.
No, principal payments are never deductible because you're just paying back money that you borrowed. When you borrowed the money, you didn't pay taxes on it. So you don't get a deduction when you pay it back.
Okay.
Okay, so here's someone who pays $500 per month for rent. We can tell that this was written originally a long time ago. And if your business use percentage is 20%, you get to deduct, well, 20% of 500 is 100 per month, or 1,200 for the whole year. Rent is almost always going to be an indirect expense. If you own your home and you pay $3,600 in property taxes, and your business use percentage is 10%, then you can deduct $360 on Form 8829, and that means only the non-business part is going to go to Schedule A. So if you have, let's say, in addition to her $3,600 in property taxes, she also had $10,000 in mortgage interest, she would also deduct $1,000 on Form 8829, and the other $9,000 would go to Schedule A. And then if you have expenses that are not related to the square footage of your home, for example, home internet use or maybe cell phone usage, telephones, a lot of people don't even have landlines anymore, but there is a rule still on the books that says no part of the first phone line in your home is ever deductible. But everybody has cell phones, so that rule is almost obsolete. But if you still have a landline, if you have one landline, none of that expense is deductible. So telephone really should be not included there. If there's two lines then, however, then you can split your bill in half. If you have a business line and a personal line.
If the whole purpose of having the internet is for work, and you can stream and do stuff on your phone otherwise,
Yeah.
can you deduct your internet?
Yes. So you would have to come up with some reasonable way to get a business percentage of that home internet use. So if you said, I don't have Netflix, I don't have any of these other streaming platforms, I don't watch internet videos. My only thing I use internet for is for business, and you can say that, and if you can back it up somehow, then you could deduct 100% of your internet costs. But what would be a reasonable way? Well, you might consider the number of hours per day that you're using, or you might consider the amount of traffic you generate. That's really kind of difficult, but I would say, like, if you're running your business from your home, you're using your home office 8 hours a day, and then you watch TV on your streaming services for 2 hours a day on average, then I could say, well, 80% of your internet usage is for business.
It's not a matter of if you use over half for business, or the whole reason that you have the internet is for business and you wouldn't pay for it otherwise for personal use. But
If you end up using it for personal use, then you have to apply a business percentage use.
okay.
So yeah, you might try to argue that, if I didn't have this business, I would have shut off the internet. But since I have it, I might as well watch Disney Plus. Then, because you're using it partially for personal, then it's not 100% business expense.
Okay.
But it does say in this case, we actually we bypassed 8829 and put it directly on a Schedule C. So sometimes we would have utilities or something like that on the Schedule C, even if you don't have a separate business location that you're renting or owning. For something like internet, I would put that into office expense most of the time instead of utilities. Even though for all practical purposes nowadays it is a utility.
So the level where a lot of home functions don't work without it.
Yeah.
The whole heating system goes down on newer stuff, and
Yeah, well, I mean, you can't really even apply for a job without internet anymore.
not to mention security systems,
Mm-hmm.
temperature regulation.
You can't apply for or select unemployment anymore if you don't have internet. Internet's,
Pretty much mandatory now.
yeah, it's a life necessity now. Okay, and then you can also deduct depreciation on your property. And we'll talk more detail about depreciation. And just like any other depreciation, you can only deduct it if you own the property. And we'll talk about this in more detail when we get to the chapter on depreciation. There is a spot directly in 8029 where you can count depreciation. So your adjusted basis for purposes of depreciation is either the fair market value on the date you started using it as a home office, or what you bought the home for, whichever is less.
So if you built the home and it cost you half of fair market, you have to use your actual costs and not the fair
Yes.
market value.
Mm-hmm. Yeah, your basis is going to be, your full basis is whatever money you invested into that home. So if you built it for $120,000 because you used mostly your own labor, that's your basis, $120,000. And then you also have to, because land is never depreciable, you have to allocate some of your purchase price or basis to the land, if there is any. If you have a condo or something like that, then there might not be any land, but most homes do have land. And then you subtract the land value from the total basis to get the basis of just the building, and then you multiply that basis by your business use percentage, and then you get to take a depreciation deduction, and it turns out to be 1/39th of the building basis.
139.
Yeah, because buildings are depreciated if they're used for business purposes other than renting to families or individuals, are depreciated over 39 years.
Okay. In the scenario we were talking about where someone might use half their yard for their business, in this kind of case, can they depreciate?
Land is never depreciable, so
No
there's not
matter
going to be
what
any
that-
depreciation. No.
So no matter what, you don't get the land depreciation.
Yeah, there's no such thing as depreciation on the land. But in the case where you built up part of your property, maybe you paved part of your property to store vehicles on that you're working on, maybe you're an auto mechanic, those improvements to the land can be depreciated.
Also by 39, or
Those are going to be depreciated over 15 years.
okay. So things that are more specific to the business location, those improvements are. Can you, if you did the work, can you allocate that, or is it only dollars you put in?
It's only dollars.
Okay.
Your labor, you can never deduct or allocate to basis or anything the value of your labor unless you are paid for it. Because you don't get a deduction because it never had income in the first place to offset it.
Would it be in many cases just simpler for your business using like half your property or the accessory building to just pay rent on it to you, and then you count a portion.
Sole proprietor cannot pay themselves rent, because you and your business are indistinguishable.
But a partnership can.
Partnership can. If you had a separate business entity that could pay you rent, that would be a different story. But if you're a sole proprietor, you cannot pay yourself rent. You and the business are the same thing.
Even if it's a single member LLC,
Yes.
so you're actually, if you wanted to do that, you're better off being a partnership.
Yeah, that's one possibility. Okay, your business use of home is considered non-residential property, or technically it's 27 and a half years for residential rental property, but you're not renting out your home office to a family, so it's not residential rental. So every other type of real estate is depreciated over 39 years. So that's where we get the 1/39th. And then there's some things for, like if you put it in service partway through the year. But I'll go into more detail for depreciation in just a few minutes. Or it might not be till Wednesday. So here's an example, here's a good worked out example. Karen Wilson, she's a freelance writer, so she's self-employed. She uses one room of her house exclusively and regularly for writing. So she has 300 square feet for her business use of home, exclusive and regular use, and primary place of business. 1,500 square feet for the full home. 300 divided by 1,500 will come out to 20%. So let me jot that down, 20%. She bought her home for $90,000 with a land value of $30,000. That's a pretty cheap house. And started using her home immediately for business in that year. And here's a worked out example on the next page. It's pretty tiny, but it's also on page 400. Here's this 12,000, and one thing that the slides aren't mentioning that they're actually getting wrong. It's getting it wrong in the book too. We have this section here says casualty losses, deductible mortgage interest, real estate taxes, and these are sometimes in the lingo, sometimes these are called tier 1 expenses. Or in the tax code, these are defined as expenses that are deductible whether or not you're using your home for business. So that's why we see mortgage interest and property taxes, because you normally get to deduct your mortgage interest and property taxes even if you didn't have a home office. And then some casualty losses you also get to deduct. However, you can only count them here if you have enough deductions to itemize. So if that's her only expenses, only itemized deductions is her mortgage interest and property taxes, even if we counted the full amount, 6,000, that's not enough to itemize. So this book is wrong. It should not go here. So I'm going to just cross that stuff out. And we have a line instead for excess mortgage interest and excess real estate taxes. Excess mortgage interest would be where we put the whole 4,500. Excess real estate taxes would be 1,500. But the rest of the calculation comes out the same. We end up adding all of our expenses. This 100 is going to actually go into the direct column.
So in this case, what does excess mean?
Excess means more than what you would be allowed to deduct as an itemized deduction.
And so if you are not allowed to, or if basically you are itemized.
If you're
that's
taking
where-
the standard deduction, you have to put all of your expenses, mortgage interest and property taxes in the excess column.
And that's beneficial to someone to
Hmm?
do so? That means they can take the full amount?
You can take your, no, it just means it goes in a different column.
Okay.
These tier one deductions, you get to deduct even if, it would increase a loss or eliminate all of your profit. These tier one deductions are always deductible. So, this is pretty rare nowadays. And then these deductions are called tier two deductions, or deductions that are only allowable because of a home office deduction. So normally, because her itemized deductions are so low, she's gonna take the standard deduction. So her mortgage interest and property taxes go into excess interest and excess property taxes. And then her insurance, utilities, and furnace repairs are all indirect. So, indirect, and so on. What the heck?
It's back.
And then this is indirect. So these indirect expenses are added up and multiplied by her business use of home deduction. So that's 18 and 12 is 3,000. 45 and 1,500 is another 6,000, so that's 9,600. 10% would be 960, so twice that is 1,920 plus the $100 in direct expenses. So her home office deduction is $2,020.
So,
But that's not counting depreciation.
if the furnace repair, say she had a garage or whatever that was where her office is, if the furnace repair was a furnace that was solely for her office, would the whole 1,200, would that go direct or would it still?
Yeah, that could be direct. So,
If it was directly for the business.
okay, and then we might have, so her depreciation deduction would be, so the basis of her home is 90,000, that's what she bought it for. 30,000 is land, gives us 60,000 for the building, and then 60,000 times 20% is 12,000 for her building basis, and then we're gonna end up dividing that by 39. Technically, the IRS wants you to multiply by 0.02564, but that's the same thing. And then that's $308 rounded to the nearest dollar. So she also has depreciation of 308, which makes her total home office deduction 2,328, and hopefully that matches what the book has. And she gets to take that full deduction because this line 8 says, what is your profit from Schedule C? What is your net profit? And it does these intermediate calculations to make sure that this doesn't end up going below zero. If her net profit from her business was only $1,000, she'd end up deducting $1,000 and the rest would end up carrying over to next year.
So the remaining 1,328 would go on to next year's taxes? And then would she get she'd still be able to get a deduction from next year, and then the 13 whatever would bring it down to zero?
Yeah,
Or as close to zero as it could get?
yeah. basically the idea is that extra home office deduction is going to sit there and wait for you to have a profit, and that's going to be able to offset that profit in the future. Depreciation is basically going to be a tier 3 deduction. So the only difference there is that you deduct all of your tier 2 deductions first, and then if you have any profit left over, you can deduct your tier 3 deduction. And the tier 3 deductions are deductions that would affect your basis. If you end up selling this home and you have like this unused depreciation, you don't have to reduce your adjusted basis by the unused depreciation because, but then the leftover depreciation is going to disappear on the future tax return and no longer be carried over. Carry over. The simplified method again is almost utter garbage and might as well not even count that, but there are sometimes you have good reasons to not want to take all the deductions you're entitled to. Remember that when earned income credit is involved, you must take all the deductions you're entitled to. So maybe you want a smaller home office deduction. So that would be where you would possibly use the simplified method. Or maybe you live with your parents and you don't pay any rent, and you use part of your home. Maybe you use part of your bedroom exclusively for business. Maybe you're a YouTube streamer or something like that. Then maybe you would use a simplified method because you don't own the home, so you can't take depreciation. You don't pay rent, so you can't take part of the rent. And really the square footage calculation doesn't really make that much sense because you would divide that part of your bedroom by the whole area of your bedroom, or would it be the whole house? So maybe you would take the simplified method if you're living in a home you don't own or you don't pay rent for. You can switch back and forth from year to year if you want to. The simplified method does not carry over from year to year. So again, it can't reduce your income below zero, your business income. I talked about, before I go into daycare providers and meals, the meal allowance for children, I should mention, when we talked about meals, I talked about the 50% limitation, and I talked about the 80% limitation. There is also, in addition, a 100% limitation. In some cases, you're allowed to deduct 100% of the meals you provide. And those cases are where providing meals is an essential part of your business. So, like if you're a restaurant or you're a roadside vendor, like that kind of thing, or you run a food truck. If providing meals is an essential part of your business and you provide meals as a business expense once in a while, 100% of that's deductible. A second time that's deductible is if you're offering meals to the general public for promotional reasons, that's deductible. So if you have a grand opening and you're giving away hot dogs to everybody who, maybe we give a free cheeseburger to everybody who does their taxes, that would be 100% deductible. And third would be if you're providing meals to your employees, remember it has to be your employees. If you're providing meals to your employees as an incentive for them to stay at work, then that's 100% deductible. So a daycare provider fits under the providing meals as an essential part of their business. The kids aren't going to sit still for 8 hours if you don't give them lunch and snacks. And instead of, they have this special rule because a lot of the time you just go grocery shopping. You don't really keep track of like what's for the kids and what's for yourself. And you're just allowed a standard deduction. You could segregate your receipts and try to take the actual what you bought for the kids, like maybe cereal and candy and peanut butter and jelly sandwiches, or you could take this standard meal and snack rate. And for Alaska, breakfast is $2.23, lunch is $4.26, same for dinner, and then for snacks during the day it's $1.27.
Some cheap snacks.
Yeah.
So that's for businesses or just for daycare?
Just for daycares.
Okay. And that's like per kid?
This is per kid, yeah. So we might figure someone's meal and snack allowance, and they might say, well, let's see, I run my daycare during the school year for 9 months out of the year, and they drop their kids off before school, and I provide breakfast, and then they come back to my place after school, and I give them a snack. And so that's one snack for each of the 10 kids for 9 months out of the year, 5 days a week for 36 weeks.
Okay, and you're not counting the number of kids on attendance each day. It's like if you've got 10 kids on your roster and only 8 of them show up, you still make 10 meals to begin with, not knowing how many are going to show up, right? Is that
Technically, you would have to calculate it for each kid, but that's such a tiny amount that Iris isn't really going to care if you just multiply it out. So something like that, if I had 10 kids times 5 days a week times 36 weeks a year, that'd be 1,800 breakfasts and 1,800 snacks. $2.23 for breakfast and $1.27 per snack, and multiply that by 1,800, and then I'd have a meal deduction of 6,300.
I'm surprised Alaska gives more than Hawaii. I always thought Hawaii would be more expensive.
Yeah, I would have thought so too, but actually fresh fruit is a lot easier to come by in Hawaii than in Alaska.
things like milk are like, I mean, even 5 or 10 years ago, it was like $10 a gallon there.
Alright, and that is our meal allowance, and then we have Schedule F, and I think all they have is just a picture of it. They don't really talk about that. Schedule F is mostly the same idea as Schedule C, except the categories are different. You have more possible categories of income, and you have different categories of expenses. Like you have things like seeds and plants, and lime and fertilizers that you wouldn't have in another business that's not farming related. Schedule F is actually a little more complicated than that. Like you can see on the second page of Schedule F, this is where if you're using the accrual method and you're keeping inventory, it's a lot of extra work. So we don't have a lot of farmers. We do have a few. Anytime you're selling crops or plants or livestock that you raise, that's a farming business. Except for pets. If you're a dog breeder or a cat breeder, that's not considered farming. But if you're raising cattle or flowers or marijuana, that's all farming, and that would be going to Schedule F.
Do you guys see much in the way of marijuana businesses through here?
Yes, and I'm the only one that's allowed to do those because of, as an enrolled agent, I have some additional, like it's called privilege, where I don't have to answer certain questions if I don't want to, or if it's not in my client's interest. That's not nearly as strong as like what a lawyer's privilege would be, where like if you said something to a lawyer that you were their client, they're not allowed to ever disclose what you said to them. I am allowed to withhold information, except when it comes to a court order. If a court orders me to, then I would have to. But if the IRS asks me nosy questions about someone's tax return and I feel like that would be incriminatory, then I can say that's privileged to refuse to answer it.
But for those type of businesses, are they treated just all the same on a Schedule F? Or
Well, the other reason
is there a lot more complexities to it?
it's more complex is because of this almost because of this law that was written in the 70s.
Because it's basically a federal, it's not legal yet.
Yeah, because marijuana is still a Schedule I controlled substance and it's still illegal federally, even though it's allowed in the state of Alaska. And there's still some promises from the Department of Justice that they won't prosecute people for marijuana businesses. They could undo that promise tomorrow and start putting legal marijuana growers and dealers in jail starting tomorrow
With federal charges.
with federal charges.
Does that mean they effectively have zero tax deductions in their business?
That's what this says. Expenditures in connection with the illegal sale of drugs, no deduction shall be allowed for any amount paid or incurred in carrying on any trade or business if your trade or business consists of trafficking in controlled substances. But remember, the definition of income is only your gains on the sale of property, so there are special rules for marijuana businesses where we can allocate most, if not all, of your expenses to the cost of goods sold. If you're a marijuana producer, if you're a grower, we can basically put almost all of your expenses into your cost of goods sold. If you're a retailer, then it's a lot more difficult because renting your storefront is not cost of goods sold because it's not. So about, but whatever you buy your products for is going to be part of your cost of goods sold. And then if you have security and storage costs, those will be part of your cost of goods sold. But your regular storefront is not going to be deductible. Hiring an employee to run the register is not deductible. So there's a lot of deductions that you just don't get if you're in that business.
Gotcha.
Okay. 1099 PATR is super rare. We get about 3 of those a year, so I won't really go into that. Oh, this is still on farm stuff. Okay, finally, well, maybe not finally, but next is self-employment tax. If you're self-employed, if you work for somebody else, they take Social Security and Medicare tax out of your paycheck and send that to the IRS, and the employer also matches that. They pay the same amount of Social Security and Medicare tax. So for every $1,000 that you're paid, 6.2% or $62 is withheld for Social Security tax, and $14.50 is withheld for Medicare tax, or 7.65% total. And the employer also pays that. So the total tax on employment, or the payroll tax, is 15.3%. But if you are self-employed, you're basically standing in the shoes of the employer and the employee, so you pay both halves of this tax. And there used to be a short form Schedule E SE, but there's not really anymore. But for most taxpayers, it's going to be, you're going to end up multiplying your net profit by, so let's say after you've done your Schedule C, you find out that you have $10,000 profit under Schedule C? Well, first, if you look through the form, you'll find out that you first multiply this by a number, it's 0.9235. Where does that number come from? Well, it's because an employer, the 7.65% that they pay is a deductible business expense to them. So if I pay you as an employee $1,000, I have to deduct $76.50 for Social Security and Medicare tax, but I also pay $76.50, so I get a deduction of not only the $1,000 I paid you, but the $76.50 that I also have to pay the IRS. So that's 100% minus that 7.65% is 92.35%. So you get that multiplication first. And then you multiply by the whole 15.3%, which is employer and employee share of Social Security and Medicare tax. If your self-employment income is more than $147,000, or if your regular employment income plus self-employment income is more than $147,000, then the computation is a little more complicated. But I won't go into that, because most people are under that. Most of our clients in there are under that threshold.
It would just be like the marginal difference you basically pay on that, and like if you made 100 in your W-2 job, and then you've got, you know,
Then only your first $47,000 is subject to the Social Security tax.
any surplus past. That basically the difference between what you made in your W-2 and the up to the maximum of whatever that 147, right? You just okay.
So after we get to multiply by this 0.9235 and then multiply by the 15.3%, self-employment tax is out of every 10,000, it's $1,413, or differently stated, that is an effective tax rate of 14.13% of your self-employment income is due as self-employment tax. And if this was your only income, was just this business activity, that's still under the standard deduction, so you're not required to pay any regular income tax, but you still have to pay this $1,400 in self-employment tax. And that's basically how self-employment tax is calculated. There is an optional method down here where you can count. So if you're trying to get enough credits to qualify for Social Security in the first place, you are allowed to voluntarily pay some Social Security tax, even if you have a loss. And that's what the optional method is all about. It's very rare for people to actually opt into that. And most of the time we don't even ask people about that. Although maybe we should once in a while, but most people don't volunteer to pay extra tax.
They'd have to basically know where they stand as far as the Social Security calculations,
Right.
and probably get a record from that department before they could even consider what that would look like, right?
Yeah. Basically that you have to have 40 quarters of coverage of Social Security to qualify for any Social Security benefits. And what this optional method does is it basically lets you pay the minimum amount of tax to qualify for 4 quarters for the year.
Wait, say that again?
It basically allows you to pay the minimum Social Security tax to qualify for all 4 quarters for the current year.
You're saying you have to pay a certain amount to get any Social Security at all?
You have to have 40 quarters of coverage throughout your lifetime to qualify for any Social Security, a quarter being a quarter of a year.
40 quarters, so 10 years
Yeah.
worth.
Yeah. So if in your entire life you only worked 9.5 years, you will not get any Social Security.
Even though they took it out during those years, right?
Yes.
You can't ask for it back.
Right. because the Social Security tax is not for your benefit, it's for the benefit of the people who are currently collecting Social Security. And I think there's also a rule that you can only elect this optional method a certain number of times in your entire life. But again, that's super rare. Okay, so once you've figured your self-employment tax on Schedule SE, oh, and if you have multiple businesses, so you have multiple Schedule Cs, or you have other self-employment, which would be income from a partnership, you would combine all of those onto a single Schedule SE. Okay, so it's the net total of all of your self-employment income. And if you and your spouse are both have self-employment income, then you'll have a separate self-employment tax, Schedule SE, for each you and your spouse.
Even on a joint venture?
Even on a joint, even on a joint tax return, or even a qualified joint venture. So you would have two Schedule Cs for the one business, and you would have two Schedule SEs, one for each spouse. Because Social Security tax and Social Security credits are counted for the individual and not for the married couple.
Overall, though, if someone had a business and they were, say, making $200,000 a year in that business, then they'd overall just pay more Social Security or self-employment tax by having their wife and themselves both on there, as opposed to just being one, because otherwise they'd be hitting the max, right? And would there be a reason that someone would choose to have them both on there?
It's not really a choice. It's if you're both working on the business, then so there's not a choice. It's if you're both owners, if you're both working in the business, it is a qualified joint venture, and you need to allocate it based on your relative effort or your relative investment in that business.
Okay, so I guess at some point I thought you mentioned that like Social Security, like the non-working spouse can get Social Security based on the years or
Yeah.
input
If you're
of-
married for at least 10 years, then you can get half of your spouse's benefit.
But that's only the Social Security payment, and it doesn't have to do with the business.
Yeah. But as far as being a qualified joint venture, there's not a choice. Just like if you sell, if you buy, if you start a corporation, you and some investors, there's no choice in how much percentage they own. It's just going to be like what did they buy? You don't get to say, well, this year you're going to be 10% owner, but next year you're going to be 15% owner because the taxes are better that way. It's not a choice. You're either you are a 10% owner, you are a 15% owner.
Well, I've seen a lot of times where people might put their spouse as the other partner, and so.
Yeah, if you're 50-50 partners, then you do a 50-50 Schedule C.
Okay. I guess I figured a lot of times people just do it for one reason or another, and it might be more like legal oriented than tax oriented, and didn't know if a lot of those people were doing it, but they're basically where they think they might get a legal protection out of doing it that way, putting them both on there. In the end, they're paying more tax and they don't know it, kind of thing.
Yeah.
You mentioned the depreciation on the property you can take for business use of home. Would all that get recaptured if you went to sell it?
Yeah.
And if the capital gain was excluded from the home because you're under the 250 or 500 threshold, would that recapture still get
Yes.
taxed?
You cannot exclude any gains that are a result of depreciation.
And so when that gets recaptured, then you're paying like a higher percentage on it, right?
No. It's just treated as regular income, and it's not subject to self-employment tax. So maybe your depreciation deduction is $1,000 a year, and you're not only saving income tax, but you're also saving the 14.13% self-employment tax. So you're maybe saving 30% on your taxes, and then when it's recaptured, when you sell it, you're only paying 22 or 24%. So you do get a benefit in the long run over that.
Especially if you expect that in a particular year you might not have much income besides that. But besides that, it seems like the primary difference is the self-employment tax on it.
Yeah.
So the income tax is just one year versus another, just getting moved or deferred.
Yeah.
Okay.
Let's see, I'll wait for Mercedes to get back.
So if someone wanted to be strategic about it, would they effectively just like sell their home in the year where they chose to essentially not work at all, take a sabbatical, sell their home in that year, have near zero income or very limited income, and that way they don't pay a lot of tax?
Yeah, you can do that.
Probably hard to schedule though.
Okay. Then your self-employment tax, once you've computed that, it's going to show up in two other places on your tax return. One is going to be other taxes. It's in part 2, which means this is not going to be able to be reduced by any non-refundable credits. So your non-refundable credits can reduce your regular tax to 0, but then you'll still owe self-employment tax on top of that. And there it goes again. So this is going to add to your tax bill, but it can still be covered by refundable credits and actual payments as usual. But then the other place it shows up on your tax return is half of it is deductible as an adjustment to your income, because that is the employer equivalent share of the self-employment tax. So out of this, if you had $10,000 in profit and you had $1,413 in self-employment tax, half of that, or $707 to get to round up, you'll deduct as an adjustment to your income.
Can we go back to the last slide for a second?
Okay. So self-employment tax is an additional tax on line 4 on Schedule 2. Schedule 2 is where you report additional taxes. And then on Schedule 1, page 2, you have an adjustment for half of your self-employment tax.
So Schedule 2, Part 1 was?
Part 2. Part 2 is Schedule 2, Part 2, line 15 for the deduction. And for the tax is Schedule 2, Part 2, line 4.
So outside of filling out the Schedule SE, on Schedule 2 you basically have your self-employment tax on Part 1, line 4, where you list the total amount that you owe. And then on line 15 you enter your deductible portion.
Yeah.
There. How do you calculate the deductible portion?
It's half. It's exactly half of your self-employment tax.
Okay. How does that? I guess there's instructions on there how to actually calculate that in the end. To minus out the deductible portion.
Yeah, it says whatever your self-employment tax is, on Schedule SE, it says, here's your self-employment tax, multiply that by half.
But you're not only paying half, so I guess I'm trying to understand.
That's the employer deductible share, so, the employer equivalent share, like an employer gets to deduct the payroll tax that they pay on behalf of their employees. Since you're in both categories, employer and employee, basically, you get to deduct half of the self-employment tax you pay.
No, you don't get taxed twice for having your own business.
So does that just mean that that amount that's on line 15, you would somehow take that value back into your Schedule C somehow?
No, it goes on adjustments on line 15, so it is reduced. Remember, adjustments, you have your total income minus adjustments is your adjusted gross income. So when you go to figure your income tax, you get to subtract that part out for income tax purposes.
Okay. Because one's a tax and one's a deductible amount, so it seems like it's kind of like the credit versus deduction, where one's more valuable than the other. I don't know if that's clicking in my head how that gets.
Yeah, let's finish this chapter and then I'll do an example.
Okay.
Okay. All right. Net self-employment income has to include you should normally include all allowable deductions for figuring your net self-employment income, because technically if you don't claim all the deductions you're entitled to, you're going to qualify for more Social Security benefits in the future than you should have, and so that's technically not allowed. I don't see the IRS ever questioning that unless you're also claiming earned income credit. So it's really a big deal if earned income credit is involved.
Would the marginal value of doing that be offset by the additional tax you pay anyway? Like,
No. No, remember when I talked about Social Security benefits, typical taxpayer only pays 15 cents for every dollar of Social Security benefits they get. Which is why up to 85% of your Social Security benefits are taxable. Normally, if your net earnings from self-employment are under 400, then you don't have to file a Schedule SE. So if you have a very small amount of self-employment income, they don't bother with the self-employment tax. However, if you're a church employee and the church has opted not to pay any Social Security or Medicare tax, then that is in addition to stuff from Schedule C and Schedule F in partnerships. If you're a church employee and your church does not pay Social Security and Medicare tax, that is considered self-employment income, because you're going to have to deal with paying both halves of the Social Security and Medicare tax.
oh, wow.
Even if you get a W-2 from that church.
So, have you seen a lot of people go into that where they start working for a church and then realize that they're paying both halves?
Mm-hmm. Certain occupations are exempt from self-employment tax, so children under age 18 working for their parents, self-employed newspaper carriers under 18 do not have to pay self-employment tax. Certain payments of insurance agents when they retire or end their business are exempt. If you're working in a foreign country and you're paying foreign Social Security taxes, you don't have to treat that as self-employment income. But if you're working for a foreign country and you're not paying foreign Social Security tax, that's considered self-employment income, even if you're not really self-employed. And then these two forms, very rare, but if you, 4029 is something like a vow of poverty. If you've taken a vow of poverty and you're working for a church, you don't have to pay Social Security and Medicare tax. And then 4361 is another form. If you're a member of the clergy or a minister, you can opt out of Social Security and Medicare tax.
Is that because the understanding that that organization has got you covered?
Yes.
Okay. It's not a matter of I'm part of a religion and we just don't pay tax in general?
Right. That basically, this one is related specifically to a vow of poverty, like you, and then this one is related to you're conscientiously or religiously opposed to public insurance. And part of the promise is that, yes, your congregation is going to take care of you in your old age.
Could one potentially do that and avoid all Social Security taxes and just rely on themselves?
Only if you're working for a church. If you work for any other employer other than a church, then you still have to pay Social Security and Medicare tax because it's taken out of your W-2. But for self-employment purposes, if you're self-employed and working for a church, you can avoid Social Security and Medicare tax.
But if you're working for a church and then you also have your own business, then you're probably still subject to the self-employment tax on your
Right.
business.
Any business that's not related to performing work as a clergyman. So in most cases, ministers, Christian Science practitioners, members of religious orders that have not taken the vow of poverty are also subject to self-employment tax on their net earnings. Clergy tax returns can get super complicated, so the only other thing I'm really going to say about this is that there is a thing called a housing allowance where you can, where a church can pay for their minister's housing or priest or whoever, and that is tax-free, but is still subject to self-employment tax.
What do you mean by tax-free? So it's not subject to income tax, but it's subject to self-employment tax?
Right. So maybe I'm a church and I hire you as a clergyman, and your salary is $50,000 a year, but I also pay for your housing. So I pay your rent for you and utilities, and that housing allowance is tax-free. So maybe I pay $30,000 a year toward your housing, so you only pay income tax on the $50,000. That's your stated salary. Even though I'm paying you $80,000 a year, $30,000 is going toward your housing.
And do they usually do that simply by somehow itemizing their pay as housing allowance versus regular
Yeah,
pay?
usually on their W-2 it will say housing allowance in that box 14, and that whatever that amount is. So, so $50,000 for wages, $30,000 for housing allowance, but the whole $80,000 for self-employment tax purposes.
If a clergyman purchases a house or already has a house, but there's a housing allowance that's getting part of their pay, does that complicate the scenario, or
Yes, it does complicate the scenario.
Okay.
So the part that you can exclude of your housing allowance is either the housing allowance, whichever of these three is the least, the actual housing allowance, the actual cost of renting, or if you're renting, or the actual cost of ownership of your home, or the third one is the fair rental value plus utilities of your home. So yeah, there's a whole complicated calculation, and there's an actual book that the IRS publishes called, it's one of the publications about clergy tax returns, and if you're interested, you could read that. We only get about 3 to 5 clergy members that we do taxes for, and I have to remind myself every year about how that actually works. Okay, due diligence reminders, and that's going to finish off Schedule C, and I'll do an example tax return so we can understand how this self-employment tax deduction and the self-employment tax works. So let's say we have
let's say we have a one person, unmarried, but head of household. How many children do we want this person to have? Three children. Let's say all under 17. And then their only income maybe is, let's say $30,000. Okay, so this person is also going to qualify for earned income credit. So this is actually going to be a pretty complicated return.
Make the income more then to, should we make the income more?
No, let's leave it like that. Okay, so their only income is business income of $30,000, and then they're also going to have, so that's their total income, and then adjustments. So they have an adjustment for 1/2 of their self-employment tax, which is going to be 30,000 times 0.9235 times 0.153. That's going to be the self-employment tax is $4,239, and 4,239 divided by 2 is rounding up to 2,120. So they actually have an adjustment for 1/2 of their self-employment tax of 2,120, which makes their adjusted gross income is $27,880. Okay, and then they're also going to have a standard deduction, just assume, of 19,400. And then we haven't introduced this yet, but I'll go ahead and include it anyway. And they're also going to have a qualified business income deduction of $496.
Is that just a flat percentage or is
Yep,
that
that's
tiers?
20% after taking the standard deduction.
20% of the difference? After the
Yeah,
standard?
20% of what their taxable income would have been.
So the
without-
AGI be 27,000?
Yes. So. So their qualified business income deduction is $1,696. Okay, so their taxable income is 27,880 minus 19,400. There's their standard deduction minus their qualified business income deduction. Taxable income 6,784. Okay, so now on page 2 of their tax return, they're going to have a tax of $678. And then they're going to have child tax credit of $678. Because remember, your child tax credit, that part is non-refundable, which brings their net regular tax to 0. And now we add on their self-employment tax.
which is the 30,000 times basically 14.13%, which was $4,239. So, total tax, $4,239. But then, now we get to their payments, they have additional child tax credit. And for purposes of calculating their earned income, this actually reduces their earned income, because it's related to earned income. So, $27,880. Do you remember how to calculate additional child tax credit?
With the minus 2,500, and then times it by 15%.
Yeah.
So it's
Exactly.
3807.
Yeah, 3,807.
And then it would be only allowed the 1,500 per child.
Right, but because she has 3 children, that'd be up to 4,500. Oh, by the way, in 2023, that's now 1,600 per child. So 3,807, and her unused child tax credit was 5,000 something. So her additional child tax credit is 3,807.
So it's the lower of the AGI or the unused portion up to a maximum of 1,500, right? So the lowest of the three, correct?
Yeah, it's the lowest of the three: the unused child tax credit, the 1,500 per child, or this calculation based on earned income.
If they did use pretty much all the child tax credit, then they really wouldn't get an additional, correct?
Right.
Because it goes up to that max.
Mm-hmm.
Okay.
Yeah, her unused child tax credit was 2,000 per child, 6,000, so she had left over $5,322. But she's capped by this earned income calculation. She also gets earned income credit, which again, this deduction for self-employment tax does reduce her earned income. So her earned income and her adjusted gross income both turn out to be $27,880. Has anybody looked that up already? Earned income credit. $27,000 is $880 for 3 children, head of household, 5,348. Is 15, 5, 11, 9,155. And again, we compare your payments. Remember, refundable credits are treated as payments. Compare that to your tax. Five minus 9 is 6. 4 minus 3 is 1. 1 minus 2 is 9. And 8 minus 4 is 4. $4,916 refund. So her child tax credit and earned income credit was enough to pay off her self-employment tax and still have some left over. So hopefully that answers your question. So half of the self-employment tax is deducted first at the beginning, before figuring out what your income tax is. But then the full amount of the self-employment tax is added on at the end as a tax.
So you're doing all these schedules first before you're doing the 1040, because this half of the self-employment tax deduction ends up on your 1040, and you don't know that until you do the rest of them, right?
Right.
Okay.
Yeah, and so this is basically the whole tax return, abbreviated, but, what are the forms we're gonna need to file this tax return?
1040,
Yeah.
Schedule 1, Schedule 2.
Mm-hmm.
And then,
Schedule 1 and 2,
And then the 1040 SE.
and the Schedule SE for self-employment tax. We also need a Schedule C for her self-employment income. We also need Schedule EIC for earned income credit.
Is there one for the child tax credit as well?
Yep. Schedule 8821 or 8812, I think. Schedule 8812 for child tax credit, and 8867 for due diligence.
Does the due diligence one go with all of them?
Yeah, anytime you have any head of household, child tax credit, or earned income credit, or market opportunity credit, you have to do an 8867.
But if you're just doing a simple W-2 tax return for a single person, then
Right.
you don't need to do that one.
Right. So, yeah, that's a lot of forms that are attached to this.
Is that like a $1,000 bill, pretty much?
This, if that was it, would be about $500.
Between all those schedules and forms?
Mhm.
Okay.
Would you use Schedule 3 on that?
Schedule 3 is other payments other than earned income credit and child tax credit. Or, yeah, other credits besides child tax credit, additional child tax credit. So if she had like a residential energy credit, that would be on Schedule 3. And that's not all. She might also have vehicle use, and then or depreciation, then we would have to add in a 4562. She might have business use of home, then we would have an 8829 also. So you can see where this tax return can be quite complicated. So the number of pages, if we just want to count pages, this is 2 pages, this is 2 pages, this is 2 pages, this is 1 page, this is 2 pages, this is 1 page, this is 2 pages, this is like 3 pages. So 2, 4, 6, 7, 8, 9, 10, 12, 15 pages for the tax return. And we charge by the form. Sometimes I joke that we charge by the weight of your tax return, but we don't charge like per page. Like some forms are more complicated than others. So this would be basically at least a $500 tax return. But if we threw in auto expenses and business use of home and some other stuff, that would be like, we'd get up to like $600 to $700.
Well, how long would you ballpark that this would take the average person to do?
Well, if they came in and they had like a profit and loss and it was super clean and it looked good, maybe 2 hours. If they had just a bunch of receipts and they're expecting us to add them up, maybe 10 hours. Really, and any time tax preparation would take more than 2 hours, we might also charge for the time that we take as well, on top of preparing the preparation of tax return.
Right, like if they bring in a bag of receipts and they expect you to go through, don't you charge them like $20 an hour or something for that?
$90 an hour.
How much?
90. If it was me doing it, it would be like $200 an hour.
Right.
Yeah. Because we can do a simple tax return, like a $300 tax return, where it was just the 1040 and the Schedule EIC and the 8867.
Like 30 minutes.
Yeah, maybe an hour or 2 for a newer preparer. I mean, while we're actually working and doing tax returns, we're making at least $90 an hour for the company, so we need to charge that much just to not lose money.